Hi all, welcome to this tutorial. So in this tutorial, we are going to cover the liquidity ratios, working capital, and about the liquidities. So let's start with the liquidities. What is a liquidity or what is a liquidity? Liquidity refers to a company's immediate capacity. Its company's immediate capacity to meet its short-term financial obligation due once within 1 year. So it is the ability, it is liquidity is measuring ability of a company to meet its short-term obligation while using its own current assets or its own current assets. So basically liquidity is the comparison between current asset and current liabilities. Current assets are those assets which can be immediately converted into cash within one operating cycle or within a year. And current liabilities are those liabilities which has to be settled or which has to be paid within one operating cycle or within 1 year. So basically the liquidities ratios or liquidity measure or it is comparing the current asset with the current liabilities. So the liquidity is measuring the ability of a company to meet its short-term obligation by using its own current assets. So the liquidity ratios is about surveying current operating period. It's about current operating period. Again, the liquidities are very crucial for the indicators for short-term creditors like bank and suppliers. They are very interested about the company's short-term liquidity. It's signaling firms' immediate financial health, operational flexibility, and creditworthiness. Normally, the liquidity ratios, which measures ability of a company to meet its short-term obligation by using its short-term financial resources. So again, before we starting, there are some limitations are there for the liquidity ratios. The first one is its timing. Liquidity ratio we are measuring, this metrics we are taking something from the balance sheet or from the other financial statement or from income statement. So again, it is not capturing the fluctuations on working capital throughout the year. It is if we are taking a current asset from the balance sheet, it's a balance sheet on a period of time, on a point of time. So it is not considering the fluctuations in current asset throughout the year. So the timing is one of the limitation of financial or ratios or liquidity ratios. Again, the quality of asset. Just assume if we have a lot of asset or a lot of receivables, current assets even in the balance sheet, the quality of that asset or that receivable is another concern. Just assume if there is a inventory balance, if it is obsolete inventory that we cannot use as a company resource. Again, if we have a lot of receivables in the balance sheet which are uncollectible or which are bad debt that we cannot consider as a qualitative assets. So the quality of asset is another concern while we are looking into liquidity ratios. Again, the industry specificity. We cannot compare a specific industry with another specific industry because it is the benchmark for each industry can be varied depending on its operating structure, its operating style. For example, in a retail company with a high turnover and cash sale require less liquidity than a manufacturing company which have a slow inventory and long credit terms. If we are comparing two industry like a retail industry and a manufacturing industry, in the retail industry normally obviously the liquidity will be required less than the manufacturing company because in a retail company there will be a high turnover and there are a lot of cash sales as well. But if you are looking into a manufacturing company, definitely the inventory movement will be slow and obviously the credit terms will be long. So if you are comparing these two, a company from a retail and a company from a manufacturing company, this might not be a meaningful comparison because each industry, even each company based on its operating structure have different industry benchmark or a company benchmark. So these are the some limitations we have to consider or we should keep in mind while we are preparing liquidity ratios. So let's start with the net working capital. Actually, what is net working capital? Net working capital, we can say that it is the difference between current asset and current liabilities. For an example, if a company have a current asset of 200,000 and same company have a current liabilities of 100,000, so the 100,000 is the net working capital in this case. So what it means that this company have 100,000 in net working capital to manage its day-to-day operations. So again, net working capital is an absolute dollar measure. We are measured is in dollar or an exact amount representing the capital available for the company's day-to-day operations. It indicates short-term cohesion of a company possesses. I mean, the formula for net working capital is current asset minus current liabilities. So that is a net working capital, which measuring how much the fund or capital available in the business to run its day-to-day operation or to meet its short-term obligation. What is the capital available in the business? So normally, as a default case, the net working capital will be positive. That means the current asset will be normally higher than the current liabilities. As a normal case, we can say that the current asset normally it will be higher than current liabilities. So it's indicate a positive liquidity. It implies liquidity and safety margin against unexpected shortfall. So in this case, the current asset company have a current asset more than the current liabilities, which means that it's a positive net working capital, which we can say as a positive sign of liquidity. That means this company have current asset than current liabilities. But in some cases, what can happen? The negative working capital also can happen. That means current asset less than current liabilities. If the current liability exceed current liability, this is often dangerous. That means this company don't have enough current asset to meet its current liabilities. In some companies, just if this company is managing effectively, for example, just to take a case, if a business or a retail business which is getting credit from the credit suppliers and it is selling goods for the cash, in that case, there can be negative working capital as well, because this company no need working capital. Its working capital is financed by its suppliers in this case. Again, if the cash collection or the inventory turnover and receivable turnover is extremely fast, we can manage even with the negative working capital. So as a general case, what we can say that the negative working capital is a negative sign of liquidity. So let's look into this example. If a company have current assets 800,000 and current liability 500,000, so in this case the net working capital is 300,000. That means current asset minus current liabilities. So which means does this company have a 300,000 fund available as a current as a net working capital to finance its daily financial operation, to finance daily operations, and after covering immediate debt. So what is immediate debt? That is its current liabilities. So in this case, this company have a $300,000 of working capital in its hand after covering its current liabilities. Again, the working capital management. Working capital management is a important task in the financial management. As we know that if we are inflated our working capital, obviously our working capital cost will be higher. Again, if our working capital become negative, it's dangerous as well. So we have to keep an optimum level of working capital to manage these both things. Just assume if we have a working capital, higher working capital, we have enough fund or excess fund in the business, so which will reduce our return. Reduce will be return. If our working capital is lower, so that means we have only limited fund that is in the working capital, so our overall return will be higher. This is about return. But when it comes to liquidity, in this case it is highly liquid. If we have more working capital in the business, the liquidity will be higher, and in this case the liquidity will be lower. So we have to manage the return and liquidity, and we have to find an optimum level working capital for the business to match or to optimize our return and liquidity. We need to meet our return expectation as well as liquidity expectation. So while we are setting a benchmark or a standard working capital, we have to decide or we have to consider the return and liquidity position both as well. So the working capital management, the risk and return, these both are very important. Or in this case, the risk mean it is liquidity risk. So we have to consider this both factor, that is our return factor and the liquidity factors, while we are setting a working capital policy or while we are deciding the working capital management. So let's move into core liquidity ratios. The first one is current ratio. Current ratio is a very basic ratio which is measuring the proportion between current asset and current liabilities. So the formula for current ratio is current asset divided by current liabilities. Again, it is comparing our total current asset with the current liabilities. So as a rule of thumb, the historically 2 ratio is considered as a benchmark. That means 2 asset for every $1 of liability. So let's look into this example. This company have a current asset of 800,000 and current liability of 500,000. So the current ratio is 1.6. So what it means that every $1 of current liability, this company has equal dollar 1.6 current asset. So normally the current ratio should be more than higher, then only our working capital will be positive. So again, the standard can be vary from industry to industry, again the company to company based on its operating structure. So normally the current asset 2 was considered as a benchmark. As a general, again it can be vary by industry to industry. So in this case, this company have 800,000 current asset and 500,000 current liability. So then the current ratio will be 1.6, which indicate that every $1 of current liability, this company have equally $1.6 of current asset. So in this case, the current liability 1 and the current asset is 1.6. So for every $1 of current asset, this company have $1.6 of every $1 of current liability, this company have $1.6 of current asset. So we'll move into the second ratio, that is quick ratio. Current ratio, there are some items like inventory and prepaid expenses, which will take time to convert into cash. So if it is inventory first thing it has to be converted into receivables, and that receivable has to be converted into cash. Then only we can liquidate the inventory. So in the quick asset ratio, quick ratio, what we are doing, we are removing this inventory and prepaid expenses from the current asset to get the quick asset. So this is the quick asset. That means from the total current asset, we are removing inventory and prepaid expenses and comparing that quick asset with the current liabilities. So here the real formula is quick asset divided by current liabilities. So why we are removing this? This is to calculate the quick ratio or asset test ratio. This normally, why we are removing this? This is to remove the inventory and prepaid expenses from the current asset. So normally the inventory will take more time. If you are looking into the total current assets list, inventory will take more time to convert into cash. The first thing, there are 2 processes are there. First, to convert inventory into cash, we have to convert the inventory into receivable and that receivable into cash. So it will take normally more time to convert. So as a to calculate the quick asset, we are removing the inventory and prepaid expenses from the total current asset, and in quick ratio we are comparing that quick asset with the current liability. So just look into this case, this example. This company have current asset 800,000 and current liability 500,000, and there is an inventory of 250,000 which is already included in 800,000 and a prepaid expenses of 50,000. So in this case, the quick ratio is 800 minus 250,000 minus 50,000. That means 500,000 divided by 500,000. That means 1 is the quick ratio. So what it indicates that this company have $1 of quick asset with every $1 of current liabilities. So this company can meet its complete current liabilities by using its own quick asset. So let's move into the third ratio, that is cash ratio. Again, the cash ratio, it is more conservative than the current ratio and quick ratio, which will consider only cash and marketable securities or cash and cash equivalents with the current liabilities. So it will be more conservative, and it will tell how much the company can set off, how much proportion of the current liabilities the company can set off immediately by using its own cash and cash equivalents. So let's look into this case. This company have a current liabilities of 500,000 and cash 100,000 and marketable securities 50,000. So the cash ratio formula is cash and cash equivalent, that is 100,000 plus 50,000 divided by 500,000. So the cash ratio is 0.3. So which indicate that every $1 of current liabilities this company have $0.3 of cash and cash equivalents. So the three important liquidity ratios what we measured is the current ratio, quick ratio and cash ratio. This is current ratio is current asset divided by current liabilities. Quick ratio means quick asset divided by current liabilities. The cash ratio is cash and cash equivalents divided by current liabilities. So let's move into the another concept, that is sustainable liquidity ratios. So for sustainable liquidity ratio, the first ratio is cash flow ratio. So in the current ratio or quick ratio, we are considering a cash, the current asset on a point of time. But in the cash flow ratio, which is evaluating cash flow during a period, and it is comparing with the current liabilities. So that's why it is called sustainable liquidity ratios. So the formula for this cash flow ratio is cash flow from the operating activities, divided by current liabilities. So it use the flow data. That means if you are looking the current asset from the balance sheet, it is a data on a point of time. If you are taking this data or cash flow from the income statement or the statement of cash flow, it is a flowing data. It is a data for a period of time. So it will become more realistic liquidity ratio once while we are comparing this with the other liquidity ratio like current ratio and quick ratio. This will become more realistic. So what it is telling that what is our operating cash flow, and we are comparing that operating cash flow with the current liabilities. So let's look into this case. If a company have a current liabilities 500,000 and this company is expecting its cash flow from operation, that is 650,000. So the cash flow ratio is 650 divided by 500,000. That means 1.3. So what it indicate that every $1 of current liabilities this company can expect $1.3 of cash flow from the operations. So which will indicate that this company can set off all its current liability by using its own operating cash or operating cash flow. So then we'll move to the defensive interval ratio. So defensive interval ratio, the formula for defensive interval ratio is quick asset divided by average daily operating expenses. So this is comparing our quick asset. Quick asset what we discussed already. From the current asset we are removing the inventory and prepaid expenses, that is our quick asset, and our average daily operating expenses. So let's look into this case. This company have quick asset of 500,000 and assume annual operating expenses is 2 million. So from this company can convert average daily operating expenses, that is 2 million divided by 365, that is 5,479. So by using this quick asset, how many days this company can survive for its daily operating expenses or average daily operating expenses? So how we can calculate this 500,000 divided by 5,479? That means 91.2 days. So what it means that this company have enough defensive asset to survive 90 days without a new sale. Even without a new sales, this company can survive 90 days of its daily operating expenses by using its own quick asset. So the defensive interval ratio, which indicate that how many days the company can survive without a new sales to meet its average daily operating expenses by using its own quick asset. So it is comparing total quick asset with the average daily expenses, operating expenses. So how many days this company can survive with its own current asset to meet its own daily operating expenses without a new sale. Even if there is a new sale happen, the quick asset will change, the situation will change again. So this is about the liquidity ratios. So the key ratios what we discussed today is current ratio. The first one is current ratio, that is current asset divided by current liabilities. Then the quick ratio is the quick asset divided by current liabilities. Then the cash ratio, cash and cash equivalents divided by current liabilities. Then the cash flow ratio, it is comparing the cash flow or operating cash flow with the cash flow ratio, which is comparing the operating cash flow with the current liabilities. So this is about today's discussion. If you have any doubt or you need extra clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.